Accounting 24, Lecture 2, Accrued Liabilities and Deferred Revenue. The following are the learning objectives. At the end of this topic, the students should be able to identify the appropriate presentation, measurement, appropriate accounting procedures, and disclosure requirements of accrued liabilities and deferred revenue. Apply with confidence the accounting procedures and principles involving recording of accrued and deferred revenue. One of the examples of accrued liabilities is payroll taxes. Under our law, the entity as employer is required to withhold from the salaries of each employee the following: income taxes payable by the employee, employee contribution to the Social Security System or SSS, employee contribution for PhilHealth, employee contribution to the Pag-ibig Fund. Such amounts withheld from the salaries of the employee shall be recognized as current liability until remitted by the entity to the appropriate government authority. So this is income taxes payable, the withholding tax payable, the SSS payable, PhilHealth payable, and Pag-ibig payable. In addition to the amounts withheld from the salaries of the employees, the entity is required by law to make a contribution for SSS, PhilHealth, and Pag-ibig Fund, representing each share in the benefits of the employee. So this is the employer's contribution on SSS, PhilHealth, and Pag-ibig Fund, representing each share in the benefits. So for our illustration, an entity reported the following payroll of the employees for the month of January. We have gross payroll 500,000, income tax withheld 20,000, SSS contribution 4,000, PhilHealth contribution 2,000, Pag-ibig contribution 1,000, a net payroll of 473,000. So the journal entry to record the gross payroll, we have the salaries expense, the total salaries expense of 500,000, and then the withholding tax payable of 20,000. Then the SSS contribution 4,000, so SSS payable. PhilHealth contribution of 2,000, PhilHealth payable 2,000. And the Pag-ibig contribution of 1,000, Pag-ibig payable 1,000. And the cash 473,000 given to the employee. In relation to the payroll for the month of January, the entity is required to make the following additional contributions. So for the employer's contribution, we have SSS 6,000. PhilHealth 3,000, Pag-ibig 2,000, a total contribution of 11,000. The journal entry to record the employer's contribution, payroll expense total of 11,000, SSS payable 6,000, PhilHealth payable 3,000, and Pag-ibig payable 2,000. The journal entry to record the remittance of the amounts withheld, the employee's contribution, and the payment of additional contribution, the employer's contribution. So we have withholding tax payable from the employee, 20,000. SSS payable, the employee's contribution of 4,000 and the employer's contribution of 6,000. So we have a total of 10,000. PhilHealth payable, 2,000 from the employee and 3,000 from the employer, a total of 5,000. Pag-ibig payable 1,000 from the employee and 2,000 from the employer. So we have a total of 3,000. And the total remitted to the Bureau of Internal Revenue, 38. Another example, we have value-added taxes. Under the National Internal Revenue Code, NIRC, a VAT registered taxpayer and those mandatorily required by the code is required to collect value-added taxes from customers on sales of tangible personal property and certain services. Such value-added taxes collected shall be remitted monthly to the Bureau of Internal Revenue. For our illustration, during a month, an entity sold goods to customers on account for 5,600,000, but that 5,600,000, that includes a VAT value-added taxes of 600,000. So the journal entry to record the sale is accounts receivable 5.6 million. Then we only have sales of 5 million. Then, credit output VAT of 600,000. In the same month, the entity purchased goods on account from suppliers for 2,240,000, but the 240,000 is the value-added tax or the input VAT. So, the purchases is debited only in the amount of 2,000, debit input VAT of 240,000. So, we have a credit of accounts payable 2,240,000. The input VAT is offset against the output VAT in order to determine the net liability of the entity. So, the journal entry to recognize the net liability at the end of the month is as follows. So, we have a credit balance of output VAT of 600,000. So, to close the output VAT, we need to debit the output VAT, 600,000. And we have a debit balance of input VAT, 240,000. So, to close the input VAT, we need to credit the input VAT of 240,000. So, we have a net liability of 360,000 that should be remitted to the Bureau of Internal Revenue. Subsequently, when the net liability is paid in the succeeding month, the journal entry is credit cash 360,000 and debit VAT payable 360,000. Gift certificates payable. This is another example of accrued liability. So, gift certificate payable are usually offered by mega malls, department stores, and supermarkets. They are selling gift certificates which are redeemable in merchandise. So, the accounting procedures for this, number one, when the gift certificates are sold. So, when the gift certificates are sold, we receive cash, so debit cash, and then we have the liability. Credit gift certificates payable. Number two, when the gift certificates are being redeemed, okay, so we don't have the liability anymore, so debit gift certificates payable and then credit sales. So number three, when the gift certificates expire or when gift certificates are not redeemed, so we are not liable anymore because the gift certificates are already expired or they did not redeem the gift certificates. So debit gift certificates payable and credit forfeited gift certificates. So this is a law. For our illustration, Cobb Department Store sells gift certificates redeemable only when merchandise is purchased. These gift certificates have no expiration date. Upon redemption or expiration, the entity recognizes the unearned revenue as realized. So, information for the current year is as follows. We have beginning balance of unearned revenue, 650,000. Gift certificates sold, 2,250,000. Gift certificates redeemed, 1,950,000. Gift certificates expected not to be redeemed, 100,000. We have the cost of goods sold of 60%. So on December 31, 2016, what amount should be reported as unearned revenue? So for our solution, we have the beginning balance of unearned revenue of 650,000. Then we have gift certificates sold, 2,250,000. What is the journal entry for this? So the journal entry, debit cash, 2,250,000. Then credit gift certificates payable. So addition to the unearned revenue, 2,250,000. A total of 2,900,000 less certificates redeemed and certificates expected not to be redeemed of 100,000, a total of 2,050,000. So how to record the gift certificates being redeemed? So this is a debit to gift certificates payable, so a deduction from the unearned revenue, and then credit to sales. Certificates expected not to be redeemed, this is still a debit to gift certificate payable and a credit to forfeited gift certificates. So, a debit, a deduction from unearned revenue. So, total deduction of 2,050,000. So, the Ending unearned revenue, December 31, 2016, we have 850,000. Another example of current liability is refundable deposits. Refundable deposits consist of cash or property received from customer but which are refundable after compliance with certain conditions. Illustration. This refundable deposit, the best example of refundable, the beast. Another example of liability is bonus. So profit sharing and bonus plans are additional incentives given to employees for a variety of reasons. The most obvious is to motivate the employees to be more productive. So the main reason for this is to motivate officers and employees by directly relating their well-being to the success of the entity. Profit sharing and bonuses are recognized when letter A, the entity has present obligation to pay for them, and letter B, the cost can be measured reliably. So large entities often compensate key officers and employees by way of a bonus. So we have the following scheme. So number 1, bonus before bonus and before tax. It means that bonus is expressed as a certain percent of income before bonus and before tax. Then number 2, bonus after bonus and before tax, meaning it is expressed as a certain percent of income after bonus but before tax. And then we have bonus before bonus and after tax, a certain percent of income before bonus and after tax. And number 4, bonus is based on income after bonus and after tax. So, to journalize, we have the following journal entry: debit bonus expense and then credit bonus. So for our illustration, we have this following formula: 4.4 million and then bonus rate of 10% and tax rate of 30%. So this is very simple because our base is the income before bonus and income tax, and the 4.4 million is given. So income before bonus and income tax, 4.4 million multiplied by the bonus rate of 10%. So we have a bonus of 440,000. So to journalize, debit, bonus expense, credit, bonus payable of 440,000. For our illustration, case number 2, we have bonus based on a certain percentage, 10% of income after bonus but before tax. Here we will use the algebra. So let I be the bonus rate. So bonus is equal to I. Bonus rate is based on income before bonus, before tax but after bonus. So income minus bonus multiplied by the bonus rate. So using this algebraic expression, so we come up to this formula: bonus is equal to bonus rate multiplied by the income divided by 1 point bonus rate. So to use this formula, using this formula, bonus is equal to bonus rate 10% multiplied to the income 4.4 million divided by 1 point I, or 1 point the bonus rate. So 1.10, 1.1. Bonus is equal to 440,000 divided by 1.10. So we have a bonus of 400,000. To record, to journalize, debit bonus expense 400,000, credit bonus payable 400,000. The same information, income before bonus and income tax, 4.4 million. Bonus rate, 10%. Income tax rate, 30%. But, case 3, bonus is a certain percentage of income after bonus and after tax. So, let I be the bonus rate. T stands for tax rate times income minus bonus. So, tax rate, we have 30% tax rate. So, using this, bonus is equal to income after bonus and after tax. So, minus B minus T. So, using this, we come up to this formula. Bonus is equal to bonus rate times income minus bonus rate times 0.30 tax rate times income divided by 1 plus bonus rate minus 0.30 or minus the tax rate. So, using this formula, we have the numerator, bonus rate 10% times income 4.4 million minus the bonus rate of 10% times 0.30 times the income of 4.4 million divided by the numerator 1 plus bonus rate 10% minus the tax rate minus 0.30. So 1 plus 0.10 minus 0.30. So equals 440,000 minus 132,000 divided by 1.07. So the bonus 308,000 divided by 1.07. So the bonus is 287,850. To record this, debit, bonus expense 287,850, credit, bonus payable 287,850. Our last illustration for bonus computation, the same information, 4.4 million, bonus rate 10%, income tax rate 30%. But now, case 4, after tax but before bonus. So, the bonus is computed as a certain percent of income after tax but before bonus. So, let I be the bonus rate. Again, T the tax percentage times income minus bonus, so the tax rate, 30%. So, using this formula, bonus is based on income after tax but before bonus, so minus T only. So, using this, we come up to this formula of bonus is equal to bonus rate times income minus bonus rate times 0.30 times income divided by 1 minus bonus rate times 0.30. So, using this formula, we have bonus rate 10%, income 4.4 million minus bonus rate 10% times 0.30 times income 4.4 million. And then we have a denominator of 1 minus bonus rate times 0.30. So, 1 minus 0.10 times 0.30. So, 440,000, 10% times 4.4 million, minus 0.10 times 0.30 times 4.4 minus 132,000, divided by 1 minus 0.10 times 0.30, 0.03. So, 1 minus 0.03. So, we have 308,000 divided by 0.97. So, we have a bonus of 317,526. So, to record this, to journalize, debit, bonus expense, 317,526, credit, bonus payable, 317,526. Another example of liability are deferred revenues. Deferred revenues are income already received but not yet earned. So if it is realizable within 1 year, it is a current liability. But if it is realizable more than 1 year, it is classified as non-current liability. So example of deferred revenue are unearned income, unearned rental income, unearned interest revenue. So for our illustration, an entity sells equipment service contracts agreeing to service equipment for a 2-year period. Cash receipts from contracts are credited to unearned revenues and service contract costs are charged to service contract expense. So when cash are received, this is credited to unearned revenue. So the journal entry, debit cash, credit, unearned revenue. And the service contract costs are charged to service contract expense. So the journal entry is debit service contract expense, then credit cash of the amount being incurred. So revenue from service contract is recognized as earned over the service period of the contract. So the following transactions are made in the first year. So we have cash receipts from service contract sold 1 million, service contract costs paid 500, service contract revenue recognized 800. So using that illustration, the journal entries are number 1, to record the receipts from contracts sold. Again, cash receipts from contracts are credited to unearned revenue. So, credit unearned service revenue 1 million and then debit cash of 1 million. Number 2, to record service contract paid. Again, service contract costs are charged to service contract expense. So, to record, debit service contract expense of 500,000 and credit cash of 500,000. So number 3, to record the service contract revenue recognized. So the service contract revenue recognized 800,000. So to record this, debit unearned service contract revenue of 800,000. So out of 1 million, the service contract revenue recognized 800,000 only. So, debit unearned service contract revenue 800,000 and then credit service contract revenue of 800,000. So, we have a remaining liability of 200,000. 1 million minus 800,000. So, 200,000 remaining liability. That's all. This is the end of lecture 2. Thank you.